Hello and welcome. You're with us on Business Today. I'm Abha Bakaya. Here are the day's top stories. A GDP growth rate of 9% is very much possible, says Prime Minister's Economic Advisory Council member Sanjeev Sanyal. Tells Business Today TV in an exclusive chat that domestic inflation has peaked. Core inflation is not a concern. India is in a much better situation than other nations. Top economist Sanjeev Sanyal tells Business Today TV that while the global economy stumbled, investors maintain their faith in India. Trade deficit more than doubles to $28 billion in August, while export rises marginally by 1.62% to $33.92 billion. Economists predict an upside risk to current account deficit forecast. Subdued global cues weigh on Dalal Street. Sensex ends 200 points in the red after plunging nearly 1,400 points in initial trade. Nifty around 18,000. Financials, metals gain, IT top drag on the index. A day after Vedanta signs a deal for a $20 billion semiconductor plant in Gujarat, Chairman Anil Agarwal announces a new hub in Maharashtra to manufacture iPhones and other gadgets with Foxconn. Car dealers seek a better level playing field against car manufacturing companies, say contracts are one-sided and favor the companies, seek the freedom to buy spare parts from the open market. It's been 2 days since inflation spooked policymakers with an unexpected rise, and industrial production fell to a 4-month low. Does this show that the Indian economy is in trouble, or is it just a passing phase to be ignored? Who better than to answer these questions than former Principal Economic Advisor and the current member of the Prime Minister's Economic Advisory Council, Sanjeev Sanyal, who spoke to Business Today TV's Managing Editor, Siddharth Zarabi. Listen in.
We are talking at a time when the latest inflation numbers in India as well as the United States have sent various signals to the markets and the broader economy, starting with your views on India's inflation and where it stands and how it's looking to you in the weeks and months ahead.
Well, the latest print for the Indian inflation, consumer price inflation, has come out at about 7%, as you know. This is outside of the 2 to 6% range, which the Monetary Policy Committee is supposed to target. So in that sense, clearly it is outside of our comfort zone. But I would like to highlight the international context in which this is happening. As you're aware, international commodity prices, particularly energy prices, have been elevated now for some time. And although they have come down a little bit on the margin, they are still very elevated now. And this is feeding through to inflation globally. Virtually every developed economy is seeing record-breaking inflation. Many emerging markets are seeing inflation running into 70–80%. I mean, countries like Turkey, for example. So in that context, I would argue that India is doing rather well. This is not to suggest that we are not concerned about it. Obviously, we want to maintain this macroeconomic stability that we have earned through hard work. I mean, introducing that inflation targeting framework, when we did that in the years 16, 17, 18, we had to earn that macroeconomic stability. We're enjoying that now, but we wouldn't want the cat to come out of the bag. So given that context, I would argue that we will be, be quite, as far as possible, using as responsible tools we can, keep that control. Now, of course, I can't speak for the Monetary Policy Committee, but I think there is a consensus that responsible macroeconomic management is key to roots to our economic management overall.
Sanjeev, you spoke about what happened to energy pricing across the world, and consumers in the West who have never seen energy prices and food prices like this. It's like a second oil shock, only it's playing out in a different way and for different reasons. How is India compared to other economies when it comes to the outlook for inflation? There are 2 points of view. One says that perhaps the worst is now behind us, and therefore fears of a global recession have receded. The other says you don't know what would happen next 2-3 months, and there seems to be a bit of skittishness in the markets as a result.
Well, of course, I am in no position to predict how exactly Russia will or will not supply energy to Europe. So that is the immediate context. But let me say that, of course, India as an energy importer, at least for the foreseeable future, will be impacted by whatever happens out of that cycle. But there is a bigger story here beyond just the immediate, shock from oil prices, but also from droughts. Incidentally, food prices are also being influenced by, or will be influenced by droughts in Europe, in China, and so on. So there are these immediate concerns. But I think there is a bigger concern in the rest of the world, particularly in the West, in that they have not done the kinds of supply-side measures needed to keep the productive side of the economy going. And you will remember the many debates that we had during the COVID period, where economists like myself had been making the point that, look, the post-COVID world is not a reinflation of the pre-COVID world. It'll have its own dynamics, its own technologies, its own supply chains, its own many other things. So in that context, you have got to maintain supply-side measures. You've got to keep investing in infrastructure and so on, and not use up all your ammunition in sending, demand, or more specifically, consumption stoking measures alone.
Packets of money?
Absolutely. Stimulus.
Helicopter money.
Helicopter money of various kinds. So they've used up their ammunition, have not spent it on creating supply-side capacities. They've not done any supply-side reforms. I mean, you look at some of their, variety of their sort of systems, so to speak, economic systems, policies, etc. They're all outdated, and they have not been keeping up with it. And contrast that with what we have been doing over many years. Even before COVID, we were doing serious supply-side measures, GST, cleaning up the banks, insolvency and bankruptcy code, the inflation targeting framework itself. But even during COVID, we continued to do reforms. We opened up the drone sector. We opened up the geospatial sector. We removed all kinds of outdated regulations from the BPO sector, from the telecoms side. We opened up trade finance in multiple ways. So we have kept doing supply-side measures, as a result of which our supply side is now vastly superior. So coming back to the point about inflation. Yes, we have some amount of this imported inflation problem, but our supply side is in good shape. Our core inflation, the underlying inflation of our system, is not a concern. I am not so sure about the West. Even if you did not have these immediate concerns, their economic systems simply are not in a position to grow at any rapid rate without being able to generate other forms of inflation, whether they have shortages, like in the UK, even the US, there are shortages of manpower in skilled areas, including truck drivers in many cases. So I'm just pointing out to you that the supply side matters.
The supply side matters. In the Indian context, therefore, do you think inflation has peaked out?
Well, domestically driven inflation has peaked out. Core inflation has peaked out. But can I make some statement about what will happen to energy prices abroad? No. Will we be immune, given that we are a major importer of many commodities? Are we immune to global trends? No. There will also perhaps be some turbulence to food prices given the droughts around the world. And even in India, we have had uneven rainfall.
And heat waves which have impacted wheat production, for example.
Yes, and we have comfortable food stocks at home, but we can't be immune to what will happen in the rest of the world if China suddenly needs to buy a large amount of extra rice. So, point I'm making to you is we are not immune to the rest of the world. Disruptions in production, say in Europe, from blackouts over winter, for example. That will have an impact on us. I mean, we import chips and all kinds of parts and machinery from, say, Germany and other parts of Europe, those could get disrupted. So what I'm trying to say is we are a part of the world. We cannot be immune to that. But let me say that India is part of the solution. Our supply side has been consistently supplying to the rest of the world things that it needs, whether it's, of course, the vaccines and pharmaceuticals is something, of course, we saw during the COVID period. But I think we will increasingly find that, the deployment of Indian products and services is a key part of tempering inflation in the world, not just in India.
Absolutely. Russian oil has helped sort of keep the overall Indian basket of crude a little tempered, but our oil marketing companies have taken a big hit in the last few months because we have gone back to a quasi-administered pricing mechanism. Fuel prices of petrol, diesel have not been raised for many months now. How long do you think this kind of situation can continue and the government and the oil marketing companies which the government owns bear such a burden?
Well, in general, we like the markets to function. But when the market breaks down because of a random shock like a war, certainly some amount of administering has to be done. This is not our first preference, but some sort of guidance and management has to be done when markets break down because of certain exigencies. So that's what we have done. That has allowed our macroeconomic conditions at home to remain in control. As oil prices have recently come off, you will have seen we have also allowed some of, I think, as things stand right now, oil companies are recouping from their sales. So I think some amount of management is being done. It's merely a matter of practical exigency. It's not our default. I don't think anybody wants to go back to the old system of complicated system of administering prices. And as and when normalcy returns to the global energy market, we will similarly go back to the old system of allowing prices to find their old level. It's a far more sensible thing to do under normal circumstances, but as I said, under circumstances where disruptions happen, then interventions are needed. And this is also true, by the way, of food prices. You may have seen we have occasionally placed restrictions on food exports and so on. That's not because we are against food exports. Far from it. We think that Indian farmers are capable of competing globally and being able to be part of our export machine. But then there are times where you have to also temper it because you have these very unusual circumstances of major droughts around the world, unprecedented at many levels.
Let's move on to the final part and your assessment of growth just beyond the headline numbers. Numbers get revised. Our GDP is restated 3-4 times. Inflation numbers get revised. But your assessment about an economy where a lot of people said that it's moving in two separate directions. The weaker part, the unorganized part, the informal sector, the MSME sector is suffering, whereas the larger organized companies have benefited from digitization, have benefited from the post-COVID bounce back in consumption, and this is now becoming a strain, including parts of the rural economy, Sanjeev.
So first, let me say that this sort of 1970s rhetoric, big business is somehow in competition with small business, may be true in certain segments. Maybe there are certain industries where that happens, but for the most part, do remember that big business and small business are hardly in competition. They are mostly in sync and complementary to each other. Most small businesses supply to or use products from large businesses. Even a small kirana shop is ultimately selling soaps and biscuits and other things from large companies. So I think, first of all, let's get away from this idea that their relationship is mostly of some sort of a competitive one, and that one of them growing is somehow bad for the other end of the spectrum. What matters in the end is that the whole ecosystem of industry grows. If that happens, then including large industry grows, then the whole supply chain tightens up. It benefits everybody. GST grows. The whole system formalizes. It's a good thing for everybody. And that formalization is happening. It's a good thing for even for small industry to formalize. And we have given all kinds of incentives to allow that to happen. So my argument, as far as the medium-term growth prospects of this country is concerned, I think our supply side, having done years now of reforms and some very difficult reforms, our supply side is in perhaps the best shape of any major economy in the world. We are, even under very difficult circumstances, we are hitting about a 7% odd GDP growth rate. But I would argue that if we say get clear roads, as say you got between 2003 and 2006, you had a phase where international situation was particularly conducive, Goldilocks kind of period, then this economy can grow at 9%. Now, can I predict that whether we win and if we will get that kind of a phase? No. But I'm just pointing out to you that our economy is capable of that kind of thing. So we have a very good, robust car, the engine is in good nick, we have a good driver in place. Now, of course, I can't predict the condition of the roads, and I wouldn't advise pressing the accelerator too hard till we get a good patch. But even with this rough patch, we are managing to do 7% growth. That is far in excess of any other comparable economy in the world. I mean, China, or certainly Europe is probably going into recession, but even China is nowhere in that same range of growth. So we are clearly doing very well, and doing it without our macroeconomic fundamentals going off kilter. I mean, even on the inflation front, yeah, it's above what we would like it to be. But given the conditions and what's happening in the rest of the world, I think we have managed our macroeconomic stability indicators rather well. So I think we are in good shape. I would advise against unnecessarily throwing that out of the window, trying to force growth through this. I would say this is a good rate. Compounding is a good thing. And if we get a clean patch, we can probably grow at 9%.
Vedanta has pipped the Tata Group to be the first Indian company to build the Apple iPhone. A day after it signed an MOU with Gujarat to set up a $20 billion semiconductor plant with Foxconn in the state, Vedanta has said it's looking at creating a hub to manufacture Apple iPhones and TV equipment. According to Chairman Anil Agarwal, the company is also looking at diving into the electric vehicle sector. Vedanta's chip partner, Foxconn, is already one of the biggest manufacturers of Apple products in the world and already has an iPhone manufacturing plant near Chennai. In a bid to quell the Maharashtra versus Gujarat debate, Agarwal has indicated that the iPhone manufacturing hub may be in Maharashtra. There could be some good news for car buyers. If car dealers have their way, spare part costs could fall drastically. Dealers have spoken out against the practice of car manufacturers allowing only spare parts supplied by them to be used in authorized showrooms. Dealers instead want the freedom to buy equally good but often cheaper parts from the open market. This is just one of the several grouses that dealers have expressed against car companies. My colleague Chetan Bhutani spoke to Manish Raj Singhania, president of FADA, about this entire issue.
Why do you feel that there's a disbalanced nature of contracts being forced upon by auto companies on dealers? Why do you think, and what do you think is going wrong?
If you recollect, in the past 5 years, a lot of OEMs exited India, and while exiting India, a lot of dealers were closed down, and we had got out a report wherein around 250 dealers had closed shops because of various OEMs exiting India. I would like to say here, while any manufacturer plans to start up a factory or a setup in India, a lot of research and hard work and planning goes into, and normally involves 3 to 5 years of time. But at the same time, while they plan their exit to India, it's never a planned exit. One fine day, we hear in the newspaper or in the media that ex-OEM has decided to exit India with its range of products. We have seen a number of instance where 2 months before their exit announcement, they have announced a new dealership, and the dealer is in the progress of building the showroom, investing his hard-earned money in the new business venture, and then he or she hears about this exit announcement. such kind of instances prompted a lot of complaints from our dealer community friends, members, prompted us to, and while they exit, dealers are short-handed. We don't get adequate compensations for our hard-earned money. A lot of liabilities are with the bank, and the relationship starts with the customer while selling a vehicle, and it has to sustain for another 5 to 7 years. So that relationship is maintained by the dealers, not the OEMs. So to sustain all this thing, a lot of complaints were given by our members to the association, and in dealer agreements, it is always a one-sided affair. We have to just sign on the dotted line. We cannot even change a comma in the dealer agreements. If we want that dealership, you better sign it, otherwise you don't get the dealership. It's the way it is. So we dealers feel the agreement that is there with the OEMs that we sign on, it's totally biased, and it is a one-sided kind of agreement. So in consultation with strong legal firms, we have developed this model dealer agreement, which is a balance between auto dealers.
Uttar Pradesh has rolled out its draft electric vehicle policy 2022 to 27, which ambitiously aims at bringing the entire state on the electric path in the next 8 years. The policy promises big incentives for those buying EVs and strong hybrid vehicles, and also sees the state emerging as a global manufacturing hub.
Just 6 months into his second term as the Chief Minister of Uttar Pradesh, Yogi Adityanath has set himself an ambitious goal to achieve in the next 8 years, of bringing the entire state on the electric vehicle mode by 2030. The policy sees an investment of more than 50,000 crore rupees and more than 1 million jobs as the state becomes a global hub for manufacturing of electric vehicles, batteries and related equipment. Those buying electric vehicle and strong hybrids will be major beneficiaries. Under the new policy, a 15% rebate will be given on purchase of two-wheelers up to a maximum of 5,000 rupees for a year from the date of issue of the policy. Additionally, for the first 3 years, the entire registration and road tax amount on both two- and four-wheelers will be waived off. This ranges between 2 to 9% of the vehicle cost. In the fourth and fifth year, a 50% relaxation will be given. The policy also sees public transport system slowly being converted to electric buses. By 2030, all government vehicles will be converted into EVs. Government employees will also be encouraged to buy electric vehicles. Charging stations will be set up at various public spaces in cities and at an interval of 25 kilometers on expressways.
Let's take a look at what else is making news in the corporate world. State Bank of India touched a new high of 564.9 rupees today, with its market cap topping 5 trillion rupees for the first time. The share has surged 26% in the past 3 months and now is at 7th position in market capitalization in the country. Goldman Sachs has downgraded Infosys, Tech Mahindra and TCS to sell on valuation and forecast concerns. The global brokerage has, however, expressed confidence in Wipro, upgrading it to a buy. The Competition Commission of India has dismissed a complaint against the PVR Inox merger by an NGO. The merger is now expected to be completed in the next 6 months, creating an entertainment giant with a combined market cap of 16,000 crore rupees. And that's where we leave it on the show tonight. Thanks so much for watching.